Silver opened with a strong gap higher, breaking through 86.3 and pushing all the way to 87.8 before getting rejected precisely at the resistance zone we mapped out in yesterday's video. That level held exactly as discussed. Not after the fact. Not by coincidence. It was identified before the market even opened. If you're new here and think this is being called retroactively, go back and watch yesterday's video. The timestamps don't lie. That's the point. This is tape reading education for short-term traders and for those learning how to read structure in real time. Not signals, not financial advice, just the structure as it existed and as it played out. Gold followed the same script. It moved higher exactly in line with what the PXG signal had already indicated before Western markets opened. That signal was posted on X well ahead of the session. Same handle as YouTube. OG John AG. The timestamp is still there. Go verify it yourself. I don't sell anything. Not here. Not there. Nothing. There's genuinely nothing in it for me. But there is something in it for you. If you want data before the market moves, that's where it shows up in real time. Videos take time to upload. By the time you're watching this, the move has already happened. That's just reality. As I'm recording, base gold is sitting at $5,150. Western silver spot and futures are both hovering around $86. Now we reach the critical setup. For silver to continue toward 92, the 87.2 to 89 zone must be cleared with aggression. Not slowly, not through consolidation. Camping inside that range kills momentum and invites shorts to reload. What we need is decisive, forceful price action that doesn't allow that zone time to breathe. That is the structure. Watch it carefully. But tonight's session is different. Shanghai reopens, and it's reopening into a market that is not the same one it left before the Lunar New Year holiday. While Shanghai was offline, Western prices moved significantly higher. The key question now is simple. Where does Shanghai open? The answer may already be in plain sight. China's largest silver recycling firm, one of the biggest scrap buyers in the country, was reportedly offering to buy back 99.99% silver at roughly $95 to $96 per ounce on Monday, while Shanghai was still closed. That's not a rumor. That's a real cash offer for physical metal nearly $10 above Western spot pricing. When the largest recycler in Shenzhen is paying that kind of premium during a holiday closure, you're not looking at speculative sentiment. You're looking at genuine physical demand expressing itself in the clearest language markets understand: price. If that recycler pricing reflects where physical demand truly sits, tonight's Shanghai Open could force a serious repricing event, one the mainstream financial media may only try to explain after it happens. But this goes deeper than price levels. There are structural pressures building beneath the surface. Naked short positions in silver are not a theory. The data supports it. The COMEX implied volatility index for silver, essentially the market's expectation of price swings over the next 30 days based on options pricing, has spiked sharply. Think of it as a stress gauge. When volatility is low, markets are orderly. When it spikes like this, the market is bracing for violent, unpredictable movement. It doesn't tell you direction. It tells you pressure is building, and that pressure has a source. Naked short positions represent a structural vulnerability that charts alone cannot fix. Only forced liquidations resolve that kind of imbalance. That's not a hot take. That's basic commodity market mechanics when paper positioning exceeds available physical backing. Reports also suggest some shorts may be trapped on the Shanghai exchange with limited ability to hedge across jurisdictions due to capital requirements. In other words, this isn't just surface-level tightness. The structure underneath is compressed. History shows how these situations resolve. Structural imbalances can build quietly for extended periods, appearing stable on the surface. But when pressure finally finds an outlet, the release tends to be sudden and severe. There's another shift worth noting. The large, obvious silver price slams that previously characterized suppression attempts have become less frequent. Instead, there appears to be increased activity in silver futures options that may achieve similar price management effects through more complex mechanisms. Implied volatility spiking aligns with that possibility. Verify the CME data yourself. Watch in real time. Now let's talk about Mexico. Yesterday, we covered the military operation that eliminated a major cartel leader on February 22nd. The immediate aftermath included airspace shutdowns, road blockades, and military mobilization. The Mexican government has coordinated with U.S. intelligence in response. On the surface, that sounds stabilizing. But historically, cartel leadership removals often lead to fragmentation, not instant order. Fragmentation creates temporary instability. In mining regions, instability means risk, kidnappings, extortion, higher operating costs, and investor hesitation. Mexico remains the world's largest silver-producing country. Roughly 1 in 4 ounces mined globally comes from Mexican soil. Any sustained disruption to mining security feeds directly into a market that is already structurally tight. So far, there is no confirmed supply disruption in official output data, but the risk warrants monitoring. Meanwhile, the geopolitical backdrop remains tense. U.S. military assets continue positioning in the Middle East at levels not seen in decades. The Iran situation has not resolved, it has paused. Historically, pauses with that level of hardware in place have not always ended quietly. Geopolitical uncertainty embeds a risk premium into gold pricing. That premium doesn't disappear until the risk does. Right now, it hasn't. Capital flows reflect that reality. Precious metals are surging while stock futures open negative. Gold is adding meaningfully to Friday's gains. Silver is up over 2%, while equities point lower. That divergence, hard assets rising as paper markets weaken, is not random. It reflects a shift in perceived safety. But here's the honest caution. High implied volatility cuts both ways. It means the market is pricing large moves in either direction. A forced short squeeze could drive silver sharply higher. But a coordinated liquidity event or broad asset sell-off could push silver down temporarily just as fast. Shanghai could open at a massive premium, confirming the recycler data, or it could open more cautiously as institutions reassess a market that moved aggressively during their closure. The Mexico situation carries structural implications, but supply disruption is not yet confirmed in production numbers. Probabilistic thinking matters here. Even high-conviction setups carry uncertainty. The structural thesis for silver is strong. The exact timing of its full expression in price is a separate question. What strengthens the case today compared to yesterday? The recycler data provides rare visibility into real physical pricing during an exchange closure. COMEX volatility is signaling stress. The short structure remains unresolved. Gold at $5,150, while equity futures open red shows where institutional capital is parking itself. All of this makes Shanghai's open tonight the most important price signal of the week. Watch it closely. If physical demand in China is truly running well above Western paper pricing, and that gap confirms at the open, then the 88.2 to 89 resistance zone on Western silver becomes the final structural barrier before the next leg higher. That zone must be cleared with force, not tested repeatedly, not absorbed slowly, not camped inside. Verify the CME volatility data. Review the recycler pricing. Track Shanghai's open relative to Western spot. Those that do the homework won't need post-event explanations. This is structural market education, not advice. Invest with logic, not hype. OG out.